Now let's talk about the next move for the Fed. CME sees the possibility of a pause in rate hikes for the March meeting at just over 20% as of this afternoon. Our next guest also thinks there's a good chance the Fed will pause rate hikes next week. We have Linda Duessel, Federated Hermes senior equity strategist. Linda, why would no action from the Fed actually be a major move here?
Well, good afternoon, and thanks for having me very much. You know, what the Fed should do next week is 25 basis point or not, it's not that much. But what it is, it's basically they're telling us whether or not they're worried about the financial situation. And, you know, whether they say they're worried or not, things are playing out as they are. And I'm so glad you had the bank analyst on before me, because that is one area of the marketplace that you do not want to have trouble. And so whether they do, and I mean, we at Federated Hermes don't think that they'll raise rates by 25 basis points. Financial stability trumps inflation risk, which will still be there when things settle down here in the banking sector.
Linda, what happens though if we do get that 25 basis point hike? How do you think the equity markets will react?
Mm-hmm. Well, we'll hear what the Fed has to say. Again, 25 basis points is not that much in the scheme of things. Everybody really believes, and we have too believed, that we are near the end of the tightening cycle. But this is a way for them to say whether or not they're concerned, and I think it might just give us another potential buying opportunity, if you will, another bad several days in the market if it sounds like, again, that the Fed is tone deaf as to what's going on and what's really important here.
Linda, just taking a look at our Wi-Fi Interactive, we're looking at XLF right now that is down 3% for the week. It's down 6.9%. The SVB collapse has really been huge for the banking sector. What's happened with First Republic and the lifeline there, what has also happened with Credit Suisse. So banking really volatile this week. Going forward, are you seeing any areas that may be in danger or the next domino to fall, so to speak?
Yeah, well, in terms of the dominoes to fall, when we're looking at the stock market, we believed at Federated Hermes that this would be a volatile year and that we would be trading in the S&P in a wide range, maybe from 3,500 to maybe 4,100. We're at about 3,900 now, so we're at the high end of that range. So the market is not really exhibiting fear, and any fear that's gone on so far in this bear market has been a rolling recession underneath, because the biggest names have come in and been strong. In fact, the big tech names have had a great run here. So what we're looking for is the sort of fear that would get the market, the entire market itself, that fear index, that VIX index, which stays stubbornly below 30. And we've been kind of looking for 40, to say that there was enough fear out there to get a flushing out of this system. Too much money still remains in this system. And too many investors are just not concerned. If you were in the financial services area, yeah, you would be. But if you were buying tech stocks, you'd be very proud of yourself, this week. And if you were out there shopping, I mean, the consumer is extremely strong. Unemployment claims are extremely low. And in fact, around the world, you're starting to see actually economic recovery and not a recession. Most people feel good. So, as we make our way through this particular time right now, we Godspeed that they're able to ring fence this situation. But we might just really need that kind of a fear to roll its way through and give us a flushing out that we think this mess requires.
Well, Linda, when you talk about that flushing out, I mean, how bad could it get with SVB's collapse? Is that a signal that maybe there's a little bit more potential danger, risk, a possible other failure there?
Yeah. Well, the big concern, and people have been saying this is not, this is not new news that private banking would be potentially the next black swan, the next big problem to show itself. And it's no wonder that this is where it's showing itself now in terms of the various banks that are being hit. But when you see a company like Credit Suisse, which of course is a global company, one of the largest banks in the world, and it has had troubles over the years, when you see a company like that on the verge. This is the type of domino theory that could go on, the type of thing that happened really back in 87. A lot of people weren't around then. I was around then. And at that time, the Fed was hiking rates into a strong economy, just like what we have now. And they stopped and they actually cut rates for a while until things settled down, which they will do here again. And then they start raising rates again. When all this is said and done, we're still going to have an inflationary problem. There's a very tight job market. And we at Federated Hermes believe cash is now king and defensive investing is the way to go. Let's not look at this, as a buying of the dips, which we still are doing.
Linda, if
I could throw in one last comment here about that, global ETFs. Global exchange traded funds, ETFs, in this last week have had their eighth largest inflow in their histories. They've been counted in any tough pullback in the stock market. People want to buy the dips, and that's what we've been waiting to see. That just settle down here. Got to flush out.
Yeah, Linda, even though people are buying the dips, there is still a lot of concern out there. There has been some comparisons drawn to this week and comparing that to what we saw back in 2008. I know the situation is very different, but I want to make it very clear for our viewers. Can you give us just one single reason as to why today and this situation with Silicon Valley Bank and some of the other regionals, why that is so different than what we saw in 2008?
Well, it is definitely very, very different. The banking sector as a whole, which was determined to be of a systemic risk, that is the biggest banks, are far stronger. Their balance sheets are far, far stronger than what they were back at that time. No matter whether people decide to sell shares of bank stock, particularly the biggest ones, this is, as you have said, and as your previous guest has said, this is about the regional banks that are not ring-fenced, if you will, that are not nearly as strong in terms of their balance sheet strength. The financial system in this country is in great shape, and actually around the world is in great shape. That is a remnant of 2008. We don't need to be fearing that, not at all. But fear is one of those things, and watch and see what happens over the weekend. People will sell now and worry about it later, no matter what we say. And that is a very healthy thing, really, after an extremely strong bull market. We pulled back at the worst 25% last year. That's nothing more than a garden variety pullback. And we really deserve more than that with this historic spending money from out of nowhere that we have done, and an inflation problem that's gone on, for a while now here, the highest in 40 years. So, a long-term investor is going to get some really good opportunities in here, but we need to be patient. Basically, what we're suggesting at Federated Hermes is humility. Don't think you can call how this is all going to work out, and then patience. And you may get some really good opportunities here.
Yeah, very, very important. Words of advice, and also that distinction between this week and 2008. Linda Duessel, always great to have you. Thanks so much for joining us.